Somewhere in Tokyo right now, a pension fund manager is sitting at a desk making a decision you will never hear about. Not about Japanese stocks, not about Japanese property, about your money. For 30 years, Japan has been quietly sending its money abroad, into US government bonds, into American mortgages, into the foundations of the global financial system, not out of generosity, because the math made sense. And the math just stopped making sense. If you've been wondering why mortgage rates refuse to come down, why stocks randomly lurch every few months, why the Fed can cut rates and financial conditions still feel tight, the answer starts in Tokyo, and it's been hiding in plain sight. To understand what's happening now, you need to go back to 1992. Japan's economy was, by any measure, extraordinary. Real estate prices had tripled in a decade. The stock market had done the same. Tokyo's Imperial Palace grounds were, at peak valuation, theoretically worth more than the entire state of California. It felt permanent. It felt structural. It felt like Japan had simply figured something out that the rest of the world hadn't. Then it collapsed. The asset bubble burst. Property crashed. Equities crashed. Banks were left holding enormous losses. And Japan entered what became known as the lost decades, a 30-year period of almost no growth, almost no inflation, and almost no wage increases. The economy didn't break dramatically. It just stopped, like someone hit pause and nobody could find the remote. So the Bank of Japan did what central banks do when they run out of conventional options. They cut rates to zero, then below zero. And when even that wasn't enough, they introduced something called yield curve control, which sounds like financial jargon, but really just means we are going to pin long-term bond yields to the floor, whether the market likes it or not. The Bank of Japan would literally buy as many government bonds as necessary to stop yields from rising. Unlimited buying, indefinitely. Japanese government bonds were paying almost nothing for decades. And that created a very specific and consequential problem. Because if you're a Japanese pension fund managing hundreds of billions of dollars, a life insurer with long-term obligations, or a bank sitting on a mountain of deposits, and your own government's bonds are yielding zero, you only have two options: accept nothing, or go shopping overseas. Japan chose to go shopping. And that single decision, made quietly by thousands of institutional investors over 30 years, changed the architecture of global finance. Here's where it gets interesting. Meet Bob. Bob wants to make money. So Bob walks into the Japanese market and borrows yen at near zero interest rates. He converts that yen into dollars. He buys US Treasury bonds yielding 4%. After fees and hedging costs, he pockets the difference. That's the yen carry trade. Borrow cheap in Japan, invest somewhere that yields more. Pocket the spread. Simple, repeatable. And at its peak, estimated by some banks to be worth trillions of dollars. Not millions, trillions. But here's the part people underestimate. Bob doesn't just buy treasuries. When your borrowing cost is near zero, suddenly everything looks attractive. Tech stocks look attractive. Emerging market bonds look attractive. Real estate looks attractive. If it has a pulse and it yields more than nothing, Bob is buying it. The carry trade didn't just flow into government bonds, it flowed into the entire risk asset universe. It was the invisible fuel underneath a decade of rising valuations. And Bob wasn't operating alone. Japanese institutional investors, the pension funds, the life insurers, the regional banks collectively became the largest foreign holders of US treasuries on the planet, one of the biggest buyers of US mortgage-backed securities, the world's largest net creditor nation. Japan became, in the most literal financial sense, the world's ATM. Not because Japan loved America, because the math made it the rational thing to do. And when the math works, it scales. Slowly at first, then everywhere. For 30 years, the global market was running on Japanese liquidity, on Japanese capital exported abroad in search of any return at all. And like all infrastructure, nobody noticed it was there, until it started to change. The entire carry trade rested on one assumption: that Japanese rates would stay near zero, not for a few years, forever. That the Bank of Japan's commitment to suppressing yields was permanent, structural, and unshakable. In 2024, that assumption broke. The Bank of Japan ended its yield curve control policy, then raised interest rates for the first time in 17 years, then raised them again. The reaction in markets was immediate and violent. The S&P 500 dropped 3%. Japan's Nikkei 225 fell more than 12% in a single day, its worst single-day drop since 1987. Not because of a recession, not because of an earnings collapse, because a central bank in Tokyo changed a number. Markets were telling you something important that day. Not about Japan specifically, about the assumption that had been quietly underwriting global asset prices for 3 decades. When the thing that was never supposed to move finally moved, everything built on top of it moved too. Here's the mechanism. When Japanese interest rates rise, two things happen simultaneously. Borrowing in yen becomes more expensive, and hedging the currency risk when you convert those yen into dollars dollars also becomes more expensive. The free money trade isn't free anymore. Bob's 4% US Treasury yield looks a lot less attractive when his cost of borrowing has tripled. The spread narrows. The trade stops making sense. And when the trade stops making sense, the capital that funded it doesn't sit still. It goes home. That's called repatriation. And it means the money that spent 30 years flowing out of Japan is starting to reverse direction, slowly, quietly, without a press conference, without a headline. The unwinding of the largest carry trade in history doesn't happen all at once. It happens the way most consequential things happen, gradually, then suddenly. This is the part most people miss entirely, and it's the most important part. Everyone watches the Federal Reserve, every press conference, every dot plot, every carefully chosen word, as if Jerome Powell is personally setting the price of your mortgage, as if one rate cut fixes everything, as if liquidity is automatic and someone will always show up to buy US debt. That assumption has been so reliable for so long that most people have stopped questioning it. But the Fed controls short-term rates, the overnight rate, the federal funds rate, the 10-year Treasury yield, the 20-year, the 30-year. Those are not set by the Fed. Those are set by supply and demand, by who is buying, by who is selling, by how much new supply the Treasury is issuing and whether there are enough willing buyers to absorb it. The US government runs trillion-dollar annual deficits, which means the Treasury has to issue enormous amounts of new debt constantly just to keep operating. Someone has to absorb that supply. For 3 decades, Japan was one of the most consistent, price-insensitive buyers of long-term US debt on Earth. They weren't buying because they thought it was a great deal. They were buying because the alternative, 0% at home, was worse. Now the alternative at home is improving, and Japan is stepping back. When demand for long-term treasuries falls, yields have to rise to attract new buyers. That's just supply and demand. And here's the consequence that flows directly from that. The Fed can cut rates at the short end of the curve, and long-term yields can stay elevated anyway. The Fed cuts. Your mortgage rate doesn't fall. Financial conditions don't ease. And everyone stares at Jerome Powell wondering why his rate cuts aren't working, while the actual answer is sitting in a Tokyo portfolio reallocation decision that never made the news. Follow this all the way through, and you start to see how deep it goes. When analysts build models to value stocks, they discount future cash flows against a long-term yield baseline. When that baseline stays elevated, the present value of future earnings falls. Valuations compress, stocks trade at lower multiples, not because companies are performing badly, because the price investors are willing to pay for future earnings has changed. That's why markets can feel unstable even when the economic headlines look calm. The instability isn't irrational, it's arithmetic. Mortgage rates work the same way. They track long-term treasury yields, not the federal funds rate. So when the Fed cuts and the long end stays pinned, mortgage rates don't move. Housing affordability stays strained. The market stays frozen. Refinancing activity stays muted. First-time buyers stay locked out. And nobody can quite explain why, because everyone is watching the wrong lever. Corporate credit follows the same logic. The companies that issued debt freely in 2020 and 2021, when rates were suppressed and capital was essentially free, are refinancing that debt now at significantly higher costs. Some of them can absorb it, some of them can't. The stress doesn't announce itself. It accumulates quietly on balance sheets until it doesn't. For 30 years, the United States benefited enormously from being on the receiving end of the world's largest carry trade. Suppressed long-term yields, consistent demand for its debt, cheap capital flowing into every corner of its financial system. It felt structural. It felt permanent. It felt like just the way things worked. It wasn't. It was a 30-year tailwind created by one country's economic misfortune and one central bank's commitment to keeping rates at zero. That tailwind is fading. The pension fund manager in Tokyo is still at his desk, still running the numbers. And the numbers are starting to point somewhere different than they did last year. You won't read about his decision tomorrow. It won't trend. It won't make a headline. But somewhere in the price of your next mortgage rate, in the next time stocks lurch for no obvious reason, in the next time a Fed rate cut fails to do what everyone expected, you'll feel it.